Welcome back. Well, earlier today, we certainly did have a big number. The CPI Consumer Price Index was released, showing a pretty significant decline in inflation. We're going to see what that may mean for the stock market in just a moment as well. Here's the news. On the left-hand side, on a year-over-year basis, the consumer price index up 3.2%. On a month-over-month basis, flat 0.0%. Core CPI, which excludes food and energy, up 0.2% on a month-over-month basis, 4.0% year-over-year. But what does that mean? We can see over here the year over year on the left hand side, consumer price index at 3.2%. Again, core CPI 4.0. The food segment of CPI was a 3.3, energy down 4.5. This is one of the big reasons why CPI declined so much because of falling energy prices. If you read into the details, there's also a decline in rental prices and housing prices, things of that nature. But first off, here we see the CPI. This is on a month-over-month basis. The white histogram bar is the number, the standard number that we report. Barely in positive territory. We can see the last time we actually had a negative month-over-month CPI was June of last year, the beginning of the inverted bond market. It's not negative, very, very close though. Core CPI month over month. This is the lowest candlestick we've seen in about 3 months, and probably the third lowest candlestick we've seen in quite a long time, years. This is CPI food year over year in red, and we can see a continuing decline in food prices. CPI energy is down now, negative in pretty significant negative territory, around 4.5% to the downside. This is the lowest candle we've seen on the energy prices in quite a while. So certainly a decline in food and energy, especially energy. The yellow line here, CPI year over year, again, turning back to the downside, takes away all the risk and all the worry we had just the past 2 months reports. CPI, core CPI in red, that excludes food and energy. So that's everything else. That's food and computers and things like that. That's also declining. And reminder, 2% is our Federal Reserve target. The Federal Reserve says we're not going to start cutting interest rates until inflation is sustainable at or below 2%. We're headed in the right direction. We're not quite there yet. Here's CPI year over year. Then, of course, this does include energy. And this is overlaid with the red line, which is crude oil. Now, crude oil has recently experienced a pop up, but as far as this number is concerned, when this number was calculated, energy prices had declined quite a bit. They've turned back to the upside. We'll see how sustainable that rally is. But we can see a very strong correlation. If energy prices continue to decline, expect inflation also to continue to decline. Here in red is the crude oil again. CPI energy on a year-over-year basis. Again, a very strong correlation. It would really behoove us to watch energy prices very closely in the next couple of months because where energy prices go, that really does lead inflation. This is CPI year over year food in red, CPI year over year energy in yellow. Just another recap. Certainly a very, very big decline. Now, is this decline manageable? Is it going to be a soft landing, or is this something that's going to lead to a precipitous drop? That's left to be seen. But as far as the Federal Reserve is concerned, we're heading in the right direction. Here's CPI in yellow year over year overlaid with the S&P 500. Now, the S&P 500 has been strong. Now, in the past, we would see, take a look at, for example, 2019, the recovery in 2020. Well, even before 2020, the rallies of 2017, 18, 19, CPI inflation was rising as a result of strong economics. The S&P 500 was rising as a result of strong economics. Well, that has kind of changed over the past couple of years. Now we see massive amounts of inflation, and that has driven the CPI up. That also has driven the S&P 500 up. Now, and I'm sure for those of you who have seen, we had an enormous rally today on the stock market. fueled in part because the market says, hey, the Federal Reserve is not going to raise interest rates. Inflation is coming down. Lower rates are better for stocks. Lower rates are better for businesses. And that's the primary reason why we saw such strong stocks today. But there is a disconnect. If we see inflation continue to cool, well, the chart, if it follows its historical pattern, as inflation comes down, that may lead to recessionary conditions, and that may also pull down the stock market as well. There is a disconnect, though, and we see over time, and this goes way back before 2015. There's a very strong correlation between CPI and the S&P 500. This disconnect won't last if history's any judge. And then, of course, we see here PPI minus CPI in red. Now, we have in a couple days producer price index. That's the cost of goods and services at the producer level, the wholesale level. And then the white line, or I'm sorry, the red line represents PPI minus CPI. So the red line shows us how much more producers are paying for goods and services and whether those prices are passed on to the consumer. Now, what you'll notice, the white line here is the S&P 500. We have a very strong correlation. If anybody has some insight to why this correlation exists, it's very interesting. We're not necessarily sure. But as stocks go up, we tend to see producer prices rise more than consumer prices. And conversely, when PPI, if you just take the PPI number and then subtract away from that the CPI number, we tend to see this go down. Well, the CPI was very weak this morning, and that's what drove this red line up. When the PPI is released in the next day or so, will that also show declines? If so, this red line will most likely retreat to the downside to some extent. But the takeaway from this is that if we expect to see weak inflation, I would say weak, but lower inflation, and the PPI minus CPI continues to go up, if this red line continues to go up, history indicates that should bode well for the stock market as well. This is another correlation, if history is any judge, should continue. Of course, on the other side, if PPI rises, if the producer prices continue to rise at the wholesale level, it's thought they'll pass on those extra costs to the consumer eventually, and that will drag this red line down. Now, speaking of the Federal Reserve, we had a major development today in the Fed funds futures. The blue histogram bars here show us the percentage chance that the Federal Reserve will keep rates unchanged at the 525 to 550 level. As of November 9th, just a couple days ago, we had Fed speakers, and November 10th, we had Fed speakers. We had an 85, 91% chance the Federal Reserve would not raise rates. 550 to 575 would represent a rate hike. Well, last week, November 13th, we had an 86% chance. Based on today's CPI number, there is now, and this is according to the Fed funds futures, a 99.8% chance the Federal Reserve will not raise rates in the next meeting. It was, a certainty that the Federal Reserve is not going to raise rates in the next meeting. But take a look to see how the percentages have changed. It's a near certainty. Based on today's CPI, the Federal Reserve will not raise rates in the next meeting. And that is up from 86%. Now, this is what the Fed funds futures look like on November 10th, just last week. Funny how things change so quickly sometimes. As of November 10th, there was a 22% chance, the best chance, the Federal Reserve would raise interest rates in the January meeting, which will take place on January 31st, 2024. 22% chance. There was a 59% chance the Federal Reserve would reduce interest rates in the June meeting, June 12th. And that's important because that's the first meeting where there's a better than 50% chance that the Federal Reserve will ease interest rates, will lower interest rates. So again, 22% of a cut in January, 59% in June of an ease. Well, that has changed. This is what it looks like today. 22% becomes 0. Actually, 0.2% chance. There is virtually no chance the Federal Reserve will raise rates in the January meeting. That was 22% just last week. Now 0.2, almost 0% chance. As of last week, there was a 59% chance the Federal Reserve would raise rates in June. June is the first month. There's a better than 50% chance. Well, 59% in June becomes 65% in May that the Federal Reserve will reduce interest rates. So the June meeting is now not the first time that, or the first meeting with a greater than 50% chance. It's moved up to May now. There's now a 65% chance the Federal Reserve will reduce interest rates as soon as May. And that's what the CPI number, that's how much of a shock the CPI number was to the markets. That now inflation declined a lot more than most analysts expected, a lot more than, probably the Federal Reserve and many of us expected. And as a result, the odds on the Fed funds futures out of Chicago now indicate there's virtually no chance. And take a look, the black line at the bottom represents the chance that Federal Reserve will raise interest rates at all. Well, at least based on this number right now, we're done raising interest rates. Now the question is, when is the Federal Reserve most likely to raise interest rates? Again, the first meeting where there's a better than 50% chance, that's May, 64.47%. We need to watch the economic calendar very closely, because if we see more numbers like we saw today, maybe we'll see these odds move up even to, the meeting prior to May. May 1st, it's every 6 weeks, so we're talking the middle of March. Maybe the March meeting will become now it'll be the first meeting with a better than 50% chance. We're not yet there yet. Right now, the best chance of the Federal Reserve raising interest rates is not until May. But sometimes the economic calendar really does shock the market. And because the Federal Reserve now is basically seen as not raising rates anymore, they're done raising interest rates. The stock market really like that. If the stock market follows through, well, that's left to be seen. But that's exactly why, the market moved today. And, everybody was so shocked to this number. It really was a big development. We have PPI. We have a lot of other economic numbers of quite significance in the near term future. So stay tuned, and we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.